Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Hello and welcome to the Weekly Option. This is episode 99 on January 31st, 2020. I'm your host, Eric. And in this week's show, we will cover the trades from last week on Cronos Group, U.S. Oil ETF, and United States Steel Company. And we discuss three new trades on Goldfields Limited, FireEye Inc., and the United States Natural Gas ETF. Now, it's always great to hear from listeners. So if you have any questions about the trades presented here or about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a short video series to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit our channel for the Weekly Option on YouTube. And I'll ask for a little bit of forgiveness right up front. My voice might be a little nasally this week. I'm overcoming a cold. I think I'll beat it. But you guys might hear it in my voice this week. So let's talk about the equity markets. So the U.S. equity markets this week had a larger pullback, marking the second consecutive week of lower stock performance. The Dow Jones Industrial Average fell 733 points week over week to close at 28,256 points on Friday. The S&P 500 index gave up nearly 70 points, ending the week at 3,225 points. Now, the topic of the week is sponsored by the Option Studio. If you want to learn to trade options without any calculus and confusing language, visit the website to learn more about the online course. Visit www.theoptionstudio.com for more information. So the topic of the week is about time frames, and not trading time frames. We might talk about that on another podcast, but perspectives. So I last week just listened to the Audible book, the audio version really, of The Infinite Game by Simon Sinek. Some of you guys might be fans of Simon, some of you might not. If you Google him on YouTube, you can find, or search for him on YouTube, you can find some of his TED Talks. Brilliant guy, obviously an author. And what he states in this book is that most people make the mistake of playing an infinite game with finite rules. Right, so we talk about beating our competitor in business, but there is no start and there's no end, right? So if we're running a physical race where there's a start and a finish, that's a finite game. But in life, the majority of the games we play are infinite. There is no start and no end. And the companies that have set out to beat their competition, typically we're playing a finite game. You can look at Microsoft versus Apple. And I think most people would say Apple won that battle because Apple was always competing against itself. They were playing an infinite game, which the way to play an infinite game is constant improvement. Microsoft, on the other hand, just wanted to beat Apple, right? So let's say they created a better iPod. It didn't matter or better MP3 player. It didn't matter because Apple turned around and created the smartphone. Microsoft tried to create a better smartphone. It didn't matter because Apple was already gaining market share and adding tablets and all sorts of other things. So he also mentioned some wars where without having a proper start or finish, without having a piece of land or some set of rules that define winning, you might be playing an infinite game with finite decisions. So in trading, I found that trading as a career is an infinite game, right? No single trade on any day is going to make or break me, and that's because of the way I trade. I'm trading to constantly be able to keep trading, right? So avoid finite decisions. A finite decision would be putting your entire risk capital into a single trade. Like a few months ago, I got an email from someone who had decided to take $30,000, and I won't talk too much, they might be listening, but they were putting all of their risk capital into one series of trades. And when they reached out to me, they were down, 14, 15 grand already. And it's too bad because I understand how long it takes most people to amass that amount of money, $30,000 of risk capital. So you don't want to treat it like you're in Vegas. You don't want to say bet on black or, a roll of 7 or something like that. The idea is that if you trade and continue to manage your risk so that every single trade will hopefully grow your capital base if you win, but if you lose, and always plan for the loss, it's not going to take you out. You don't want any trade to take you out. And the other thing too is one of my concepts I mentioned, I believe it was last week on the podcast. Like, I look at trades as a first decision. It's like a first negotiation. And then as long as there's time left on that month for the option, I'm going to probably make another trade that will alter the results. So there is no bad trade decision right up front. There are better decisions for sure, but bad is truly based on a time frame, right? And all of our options have a time frame. So there is a finite aspect to options expiration, but when it comes to your trading career and your success over time, it's infinite, my friend. So anyway, that's it. Expand the time frame that you look at for not just trading, but maybe other parts of your life too, and it might truly expand your knowledge base and give you a plan of how you can win and whatever it might be, given a longer or even shorter time frame. So that's it. The book was Infinite Games by Simon Sinek. I'm a big fan, and it really helped me put into words some of my ideas that I live by and have lived by for a long time. So that's it for the topic of the week. Let's dive into the trade review from last week's trades. Of course, we always start with the covered call. And last week we looked at Cronos Group, symbol C as in Charlie, R as in Romeo, O as in Oscar, N as in November. At the time, the stock was trading for $7.58 per share. We looked at buying that stock and selling the February 8 call, selling it at 35 cents, hoping for a 10.16% return in 4 weeks. Well, Cronos Group stock lost 40 cents this week, closing at $7.18 per share. The February 8 call that we sold fell 7 cents, so it ended the week being offered at 28 cents. That leads to a net loss overall of 33 cents per share on this trade. Now, we can actually buy in that February 8 call and then sell the February 7.5 call at 39 cents. So this actually mitigates a little bit of risk we had, or a little bit of loss that we had over the week. It does lead to a lower maximum profit. Our total profit would fall from a hope of 10% down to a 5% return if the stock finishes above $7.50 per share in 3 weeks. Again, the goal is to keep the trade alive long enough to be able to either lock in profit or mitigate risk. Now, our next trade is the credit spread. We looked at the U.S. Oil ETF, symbol U as in uniform, S as in Sierra, O as in Oscar. At the time, the stock was trading for $11.43 per share. We looked at selling that February 11.5 12 call spread, collecting 18 cents, which gives us a maximum possible loss of 32 cents. The U.S. Oil ETF actually fell 59 cents per share this week, ending at $10.84. The call spread we sold is even more out of the money now, which is great. So if we were to close this trade today, we would pay 10 cents for the spread, locking in an 8 cents gain over the week. Of course, this trade is working, so I don't see any reason to close it anytime soon. No adjustments are needed at this point. Just keep the original break-even point in mind, and that's $11.68. And our final trade from last week, and sorry I'm pushing right through these. This is just one of the examples. Some of the best shows are the shows where I lose money on all of the trades, because at least then you get to hear how I would adjust the trade. When I make money on the trades, then the shows tend to be a little faster as well. Since I'm dealing with a little bit of a cold, I'm probably pushing through. So if I'm speaking fast, forgive me. I promise to be better next week. But our final trade of the week is a debit spread. We looked at the United States Steel Company, symbol X as in X-ray. At the time, the stock was trading for $9.40. We looked at buying the February 10, 9.5 put spread paying 33 cents, hoping for a maximum gain of 17 cents or a 51% return on your capital in 4 weeks. Well, the U.S. Steel Company stock fell 33 cents, ending the week at $9.07 per share. The in-the-money put spread we purchased is even more in the money now. So if we were to close this trade out right now, we would actually take a 1 cent loss due to having to cross the bid-ask spread. But if we were going to buy more of this trade, it would cost us 40 cents per spread, which is an increase of 7 cents per spread over what we paid last week. So as long as stock finishes under $9.50 per share in 3 weeks, we will lock in a gain of 17 cents per spread. That's the 51% return on your capital. So that's great. No adjustments are needed at this time. However, for the busybodies in the room, you can always decide to sell a deep out-of-the-money put spread to improve your overall return scenario. So if you sold the February 8.5 put spread against this, you would collect 11 cents. And if stock prices end up finishing below $9.50 per share, but above $8.50 per share, your gain would actually be a total of 28 cents per spread. That's an 85% return on your capital expended. Not bad. If stock prices were to finish below $8 per share, your maximum loss is 22 cents per share. And without adding, if you decided not to do this additional trade, right now you have a total risk of 33 cents per spread because you paid 33 cents for that original put spread. So by actually adding this other short spread, it leads to a 33% reduction in risk while increasing your maximum profit by roughly 30%. And that, my friends, is the joy of understanding options. So notice that I didn't use any calculus, just simple math. I mean, I promise it's, subtraction and addition. That's why I always laugh when people say, when these professionals get on TV and they say derivatives should only be traded by the professionals. Well, if you understand the full risk of your position, you absolutely should trade derivatives too. And honestly, I can't imagine trading stock and not having this knowledge. I mean, most of the time, people on TV, your financial advisors, they'll tell you to hope for a 10% gain. If you get to 15% in a year, that's amazing. Each week we talk about trades where you might have a chance to lock in, a 30% return, 40% return. I mean, try getting that in the stock market on your capital, right? There are benefits to the stock. Don't get me wrong. I'm in the stock market as well, but just understand that this knowledge can significantly increase your overall returns. So let's dive into the trades for this week. We're going to look at the covered call to start. This week I'm looking at a new one. It's Goldfields Limited, ADR, symbol G as in golf, F as in foxtrot, I as in India. The stock ended the week at $6.40 per share. Now I'm looking at buying that stock and selling the February 7 call at 8 cents, hoping for a return of 10.63% over the next 3 weeks. Then you enter this trade by buying GFI stock for $6.40 per share and selling the February 7 call at 8 cents. This trade makes the most money if stock prices finish above $7 per share, and the break-even price on this trade is $6.32. The stock purchase would actually require $640, and then you would collect $8 for selling the option. Next up, we'll take a look at the credit spread for the week. Looking at FireEye Inc., symbol F as in Foxtrot, E as in Echo, Y as in Yankee, E as in Echo. Stock ended the week at $15.98 per share, and I'm looking at selling the February 16.5 call spread at 18 cents, which can lead to a maximum possible loss of 32 cents per spread in 3 weeks. Now, you enter this trade by selling the February 16 call at 82 cents and concurrently buying the February 16 half call for 64 cents. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices finish below $16 per share. The break-even price is $16.18 per share. In real terms, you would receive $18 for selling the spread and have $32 at risk. So I've had a few people email me, and they ask me why I discuss the maximum possible loss on these credit spreads. That's because When you trade a spread, whether you buy it or sell it, right off the bat, you know what your maximum gain is, and you know what your maximum loss is. So if you can't handle a possible loss of 32 cents per spread in order to lock in 18 cents per spread, you probably shouldn't trade. Try buying the stock, right? Your broker normally doesn't say, you could lose $3 a share, or you could actually lose $10 per share in this stock. But it's always true. So when it comes to trading option spreads, I like knowing the risk, knowing how much I can gain and what I could possibly lose, because that allows me to size my trade correctly so that I don't lose all of my capital on any one trade. Then the final trade for this week is a debit spread. We're looking at the United States Natural Gas ETF, symbol U as in uniform, N as in November, G as in golf. The stock ended the week at $14.37 per share. I'm looking at buying the February 15, 14.5 put spread, paying 35 cents per spread, which could give us a maximum gain of 15 cents or 43% return in 3 weeks. Now, you enter this trade by buying the February 15 put for 89 cents and concurrently selling the February 14 half put at 54 cents. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices stay below $14.50 per share. The break-even price on this trade is $14.65. You will actually pay $35 to enter the spread, and your maximum gain is going to be $15 per spread. Now, some of you might say that's not much money, but go do a 100 lot. Now you're talking about making $3,500 or spending $3,500 in order to make $1,500. I mean, the numbers really depend on the volume that you want. But for those of you who are getting your feet wet, just kind of dipping a toe in, you can do one lot. You can pay $35 and know that you might gain $15 per spread, and that's it. So you guys already know I'm like the option cheerleader here. I can't cheer too long on this episode, mostly because my throat is starting to get dry. So I will go eat an orange and take some vitamin C. I hope you guys have an amazing week. Happy trading.
Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.